Audit. Firstly, audit risk, right? And this is the technical article which is written by the examiner, a AAA technical article which was written by the AAA examiner, and in which he explained you the exam technique which is required for the audit risk question. So, firstly, she just gave us the definitions about the business risk. That what is business risk, which we you can see, and that a risk resulting from significant conditions, events, circumstances, actions, or inactions that could adversely affect an entity's ability to achieve its objectives and execute its strategies from the setting of inappropriate objectives and strategies. Risk of material misstatement exists in figures or disclosures within financial statement. What is audit risk? A risk that auditor express in inappropriate audit opinion when the financial statements are materially misstated. Right now, how audit risk interact? We already looked at it. Audit risk is equal to risk of material misstatement and detection risk. For risk of misstatement to occur, there must be an inherent risk. What can be the inherent risk? Inherent risk can be anything which business risk which a business carrying it from the start of the business till the end. For example, risk of obsolescence, risk of bad debts. If you are operating in business fashion industry, risk of fashion going out. So now the main thing which we have to look at is that how to apply the knowledge. So see, examiner itself saying that knowing these definitions will won't help you remember that which type of risk is or which of categories rise in this types. You do not need to tell them. He already knows it. So you remember that you will be asked to prepare an answer for the attention of audit engagement partner and the partner already knows what is audit risk, what is business risk, and that sort of stuff. So these definitions are only for the type will be given to you to recognize that which type of risk you are dealing in a question. Now let's look at the example over here. This was a question of I think December 2015, right? Which examiner gives you as an example. Delhi company was established 20 years ago and has become known as a leading supplier of machinery used in the wiring industry with the customers operating quarries which extract some use mainly for construction, right? Now, machines and equipment made by Delhi company are mostly made to order in the company's three manufacturing sites. Customers approach Delhi to design and develop machine or piece of you know equipment specific to their needs, where management considers that design work will be significant and the customer is required to pay 30% payment in advance, which is used to fund the design work. The remaining 70% is paid on delivery of the machinery to the customer. Typically, machinery takes 3 months to build, and smaller piece of equipment takes on average 6 months. The design and manufacture of bespoke machinery wood involving payment in advance has increased during the year. Delhi company also manufacture a range of generic products which are offered for sale to all customers, including drills, conveyors, and crushing equipment. Now, if you are dealing the business risk in the exam, so this risk can be usually thought of in terms of conditions that may prevent a business from meeting its objectives and might include risk to achieve future profits or cash flows or business survival. This is a simplified exam explanation, but will help you describe implications of most risks you come across in the exam. Generally, you are looking for the risk in the information that the examiner has presented to you within scenario. You will be asked to evaluate those risks. At this level, you will not be credited. See, examiner saying you will not be crediting for defining business risk, or nor you will be received credit for describing describing what client could do to mitigate those business risks. Right now, see what marks will help you to get the maximum marks. If you identify only the company manufactures bespoke machines for clients, which may take 6 months to complete, you just identified it. You will get half a mark for it, right? Now, identify and briefly explain that company manufactures bespoke machine for clients, which may take 6 months to complete. During this time, company has two funds tied up in working progress. You will get 1 mark, whereas each business risk can award you up to 2 marks. So again, you won't get full marks. Now, how you can get full marks? Here it is. Identify and when well explained. Hope you can do that. Company manufacture bespoke machine for clients, which may take 6 months to complete. During this time, the company has funds tied up in working progress, which could give rise to cash flow problems, especially as the 30% deposit may not cover all the upfront costs. The service has increased in the year, putting further strains on cash flows. Right, this is how you can get the full marks in the business risk. Now, the risk of material misstatement. Risk of material misstatement often follow business risk and are the impact that those risks might have on the financial statement that as well. So when you will be describing risk of material misstatement, an effective approach to use the following steps to construct your answer. What will be your steps to construct the answer? Number one, calculate and conclude on the materiality of the issue. Where sufficient information is available, right, you will get a mark. A 1 mark will be given for a correct and relevant calculation of materiality with an appropriate calculation. Number two, brief. You have to describe briefly the relevant financial reporting requirement. No credit is awarded for the accounting standard names or numbers. You won't need to tell accounting standards name or numbers, which I told you earlier as well. Then number three, relate the risk in the scenario to the accounting treatment, and then illustrate the impact of risk on financial statements. So let me write these the technique for this technique for you, right? You will be attempting risk of material misstatement question, right? Number one, what you will do? Materiality. Number two, what was that? Number two, what was number two? Let me show you again. Um, discuss or relevant reporting standard. Number three, impact of risk. Impact of risk on financial statement, right? So simply MDI, materiality, you will get 1 mark. Discussing the accounting standard, you will get 1 mark. Three, impact of risk on financial statements, 1 mark. Maximum marks you can avail on the audit on this question in 1 point is 3 marks. Sometimes it is possible that you won't get materiality to calculate, or there is no reporting standard issue, right? So you will avail 2 marks as well. Another thing, there is a cap of 4 marks on materiality. That means you can gain maximum 4 marks by calculating materiality, not more than that, Right, so let's go back to the article which we were looking at. So let us look at the example, and the scenario which we are using is the same. The company receives a 30% deposit for the design of bespoke machinery. Revenue should be recognized over a time at a point in time when control is passed. Such points will be determined by the contractual terms. Payments received in advance of control passing should be recognized as deferred income. One mark, and then there is a risk that revenue might be recognized early when payment is received rather than being deferred. You will get another mark. The would result in overstatement of revenue and understatement of liability for deferred income. Same way, you can write it for inventory valuation. The company manufacture machine for a period of up to 3 months. This gives rise to work in progress. Work in progress is valued at lower of cost or NRV, where cost include all the cost of purchase and conversion, including overheads of getting the item to its present location and condition. Okay, there is a risk that order for bespoke machinery is cancelled. Inventory NRV falls below the cost incurred. This would result in overstatement of inventory or assets in the statement of financial statement and the statement of cost of sales, therefore an overstatement of profit. Now, here you will get 2 marks because you did not have sufficient information to calculate materiality, right? Now, as far as the audit risk is concerned, audit risk basically is the another component that is to calculate the audit risk. Now you will get in audit risk, you will get another head that is to identify detection risk. Now, uh, what can be the detection risk for you? Number one, you are your firm auditing the client first time. Obviously, you have less understanding of client. That will be a detection risk. There can be a detection risk for you. Number two, um, your firm, sorry, the client is seeking to list it on stock exchange. That's another example of detection risk. Okay. Um, Client is seeking to get funds for loan. Obviously, there is a chances of manipulation, and there can be a detection risk issue, right? So this can be example of it, and that's the technique which we need to know for this audit risk scenarios. I hope you get it.